In the comments of a past video, I mentioned that I have a strategy for investing with almost no danger of financial loss from a market crash. Please note that I am not a certified financial advisor. You should always do your own due diligence, and this is just my opinion. That said, many of the subscribers from our channel asked me to tell them what this strategy is, either in the comments or through email. First, before you start investing, you should ask yourself, what is your risk tolerance and what is your investment goal? Your investment goal determines your investment timeline. For example, if you have a high risk tolerance and you are investing for your retirement plan in 40 years, then a diverse portfolio of stocks would be risk-free. This is because it is very unlikely that a bear market will last 40 years. However, if you have a low risk tolerance and your investment goal is to retire in less than 10 years, then you should invest in opposites in order to avoid losses from a market crash. For example, usually when stock prices go up, bond yields go down. When bond yields go up, stock prices go down. If you invest in both stocks and bonds, the theory is that the gains from one will offset the losses from the other opposite investment. Some tax-advantaged retirement accounts allow you to trade individual stocks and bonds. However, most tax-advantaged retirement accounts require you to invest in stock mutual funds and bond funds. Another opposite investment pair would be metals and cash. When the buying power of cash goes down, the price of metals go up. When the price of metals go down, the buying power of cash goes up. The buying power of cash goes down when the Federal Reserve Bank says the economy is in a state of inflation. The buying power of cash goes up when the Federal Reserve Bank doesn't say that the economy is in a state of inflation. The metals to invest in are gold and silver. In order to determine which metal to buy, calculate the historical gold to silver price ratio. You calculate the gold to silver price ratio by dividing the price of gold by the price of silver. You may look up historical gold and silver prices on kitco.com. If the current gold to silver ratio is high compared to the historical gold to silver ratio, then the gold is expensive while silver is cheap. I would buy silver in this example. However, if the gold to silver ratio is low, then I would buy gold. Holding actual physical gold or silver is not a liquid investment. Gold and silver ETFs are more liquid and will allow you to easily invest in metals in your tax-advantaged retirement account. You may easily trade ETFs online with a stock brokerage account. With regard to cash, you don't have to hold your cash in US dollars. Some banks will allow you to hold an account denominated in foreign currency. This is called a Forex trading account. If you're up to date on international trade politics, you may want to trade in a Forex account. However, keep in mind that Forex trading is usually a lot more volatile than holding your national currency in a normal interest-bearing savings account. I've made over 20% from buying and selling Japanese yen. However, I've also lost over 20% from buying and selling Swiss francs. I no longer do any Forex trading. I don't think I'm knowledgeable enough in international trade politics to consistently make big enough profits to justify all the work and research I do in preparation for every trade. Other investment classes include real estate and cryptocurrency. Real estate prices generally move in opposite to bond yields, just like stocks. However, real estate is not a very liquid investment, and if you have the wrong tenants, you may lose money and time fighting frivolous lawsuits in court. You will also have to spend time and money maintaining the property. However, if you purchase real estate using a REIT, you won't have to deal with tenant lawsuits. A REIT is a real estate investment trust that you can trade online using a stock brokerage account. REITs are also very liquid. Unlike owning real property, however, a REIT is not a real safe investment. All REITs that I am aware of are actually leveraged investment vehicles based on floating interest rates. REITs may lose a ton of money when interest rates go up. If you know of a REIT that is not a leverage investment vehicle, then please post its trading symbol in the comment section for me. Thanks. Many would argue that cryptocurrency is the future of money. However, cryptocurrency prices do not follow that of metals nor cash. They actually correlate slightly with the stock market. The biggest cryptocurrencies are Bitcoin and Ethereum. Due to regulatory agency obstacles in many countries, cryptocurrency is sometimes not very liquid, especially in large amounts. Buying a Bitcoin or Ethereum ETF will allow you to hold cryptocurrency in your tax-advantaged retirement account. Also, ETFs are very liquid. Generally speaking, the asset class that offers the best rate of return is stocks. Historically, the average return from an all-stock portfolio is 11% per year. I'm comfortable with a moderately high-risk portfolio. I read the Wall Street Journal daily in order to keep my finger on the pulse of the economy. I've been pretty successful at market timing my portfolio. I'm not a psychic. I cannot market time to buy at the very bottom of a bear market, nor am I lucky enough to sell at the very top of a bull market. I also would not recommend that anyone try to time their transactions for the very top and bottom of a stock market cycle. This is because you are not a psychic, and if you hold on to your position for too long, you risk holding the bag when the market unexpectedly crashes. I'll generally hold an all-stock portfolio until I've made an 11% return on investment. Then I'll start selling stock little by little. If the interest rates are high and expected to go down in the future, then I'll buy bonds with a fixed interest rate while selling stocks. If market conditions are not good for buying bonds, then I'll buy either metals or cash with the proceeds from the sale of stock. I'll generally hold on to a stock mutual fund in a bull market until the following conditions are met. 1. The S&P 500 is at an all-time high. 2. I've made at least an 11% return on my investment. 3. The volume of trading is spiking. The stock market generally goes up and down. I don't panic when it goes down, and I don't start selling just because it has gone up a lot. However, if a stock market has gone up a lot and the volume of trading has spiked, then I'll sell all my mutual funds. Often a large spike in trading precedes a stock market crash. By the way, I hate buying mutual funds because mutual funds are forced to be balanced. For example, a hypothetical mutual fund has only 2 stocks during the dawn of the age of automobiles. 50% of the mutual fund is invested in Ford Motor Company, and the other 50% is invested in the Durant Horse Carriage Company. Because Ford stock has gone up 1,000% in 1 year, your portfolio is 90% Ford and only 10% Durant. However, mutual funds are not allowed to hold 90% of its value in just one stock. Therefore, your mutual fund has to continuously sell winners and buy losers in order to keep the portfolio 50% Ford and 50% Durant. If I like a mutual fund, I'll buy the stocks in the mutual fund instead of buying the actual mutual fund. By law, all mutual funds have to make available a document online that lists all the biggest investments in a mutual fund. This document is called a prospectus. However, most employer 401k plans do not allow you to buy individual stocks. You're required to buy mutual funds in your 401k. Finally, if you are very risk averse, I would recommend that you research the possibility of purchasing stocks in companies that have paid a reliable dividend for the last 25 years. This is because even if you missed the bottom of a stock market crash when you bought stock in a company, the dividend shields you from loss, even if the bear market lasts several years. For example, stock starts at $100 per share and pays $5 per share dividend. However, the stock market crashed and now the stock is worth $50 per share. You bought the stock at $50 per share, but the stock price fell to $40 per share after you bought it. Let's say that the stock price never recovers and stays at $40 per share. Well, at a dividend of $5 per share, that's a 12.5% dividend. That's a very good dividend that beats the 11% average annual rate of return on stocks. As a matter of fact, in 2 years, you'll make back your loss from the fall in the stock's share price with the dividends from the stock. At year 3 and beyond, the dividends you receive will be pure profit. If this stock did not have a dividend, you'll have to eat a 10% loss. Some people use insurance products and options to shield them from a market crash. Professional financial planners love using these insurance products and options. However, unless you're extremely risk averse, I don't recommend using these insurance products and options because they cost money to buy. Also, a lot of these insurance products have a minimum investment of $250,000. If you can stomach some risk in your portfolio, I would keep some cash on hand for a rainy day instead. The average stock bear market lasts 9 months. Instead of buying financial products to shield me from a market crash, I'll hold enough cash to pay all my bills for 9 to 18 months. That way I don't have to sell stocks in a market crash to pay my bills. Nothing kills a portfolio faster than having to sell in a down market. Another investment strategy to weather a stock market crash without killing your portfolio is simply to live within your means. For example, let's say your portfolio pays you $15,000 per year in dividends. However, the stock market crashes and one of the companies paying your dividends goes under. You now only make $40,000 per year in dividends. If you only have $40,000 per year in bills to pay, then you're okay. You don't have to sell stocks in a down market to pay your bills. Finally, the other major thing that can really kill a portfolio is tax. Be sure to hire a CPA to consult with and do your taxes. That way, you don't get hit with outrageous taxes and burn through your retirement portfolio. Nobody is a psychic. Tax rates could go up or down in the future. Roth IRAs tax you now, but your retirement withdrawals are generally not taxed. 401ks are not taxed now, but taxed later when you retire. I have both a Roth and a 401k. Therefore, if the tax rate in the future when I retire is high, I'll withdraw more money from my Roth than my 401k. However, if the tax rate is low in the future when I retire, then I'll withdraw more money from my 401k than from my Roth. Having both a Roth and a 401k gives you tax flexibility. As a rule of thumb, if you're in your 20s and just starting to work, you should put your money in a Roth IRA for the next 8 years. This is because your income is usually lower when you're younger. This puts you in a lower tax bracket. Since a Roth IRA taxes you now and allows tax-free distributions later, this is generally a good strategy if you're just starting to work. If you've been putting all your money in a Roth for at least 8 years or more, and you have no 401k, then you should put all your future contributions into a 401k. This is just a rule of thumb. To figure out specifically what you should do, I suggest you employ a financial planner. This concludes our little investment primer. When you have questions and comments, I invite you to post them below. Let's keep it real.